Hi everyone. Today on Market Makers, we have Mr. Ganesh Mohan, CEO of Bajaj Finserv Asset Management. Ganesh is an IIT IIM graduate and has worked at BCG for 16 years before joining Bajaj Finserv in 2015. Ganesh, welcome to the show.
Thank you, Milan. Glad to be here.
Thank you. Let's start with some basic questions. So tell us about this multi-asset allocation fund. How are these funds, different from other funds, and what is the idea behind them?
Yeah. So multi-asset, as its name suggests, Milan, is a fund that can invest in multiple types of asset classes. So equity, fixed income, commodities, which can be gold, silver, many other commodities, real estate investment trusts, and even international equities. So what it does is it gives you a diversified set of assets, many of which are not correlated, and therefore gives you a diversified portfolio in the fund. And it does it all within the construct of one single fund, rather than having to invest in multiple funds to achieve the same objective. Now, the way it is different is, firstly, of course, it gives you all of the opportunities to invest in all of these asset classes in one fund. And that's important because you never know which is going to be the winning asset class in any given year. Right? So it's always helpful to have one fund where you have all of these asset classes. It is also one where the fund manager can help with deciding what is the right kind of asset allocation at any point of time. And it is one fund which acts almost as an all-weather investment avenue, right? For you to have your entire portfolio comprising across multiple different uncorrelated assets, which reduces the risk experience that investors face and increases the amount of diversification that they also get in their portfolio.
Got it. And coming particularly to Bajaj Finserv multi-asset allocation fund, let's break it down. How are you going to decide the allocation of to various asset classes, that is stocks, commodities, debt?
Yeah. So first of all, we will position this very much under equity taxation. So our gross equity exposure will always be above 65%. And we will start the equity allocations around, let's say, in the 65 to 70% kind of a range. Fixed income will be around the 20% range or so. And gold/other commodities will be roughly in the 10% kind of a range. We will seek opportunistic investments, potentially in REITs and InvITs as well. But this will broadly be the overall asset allocation that we will be looking to work with. Within this, of course, on the equity side, we will be focusing on a very specific strategy because we believe that equity really helps drive differentiation in terms of the returns. And within the fixed income side, what we will do is we will look much more from a dynamic duration management perspective. Based on our proprietary models, we look at what are the opportunities in the yield curve. So we will deploy based on that. And the commodities becomes predominantly a gold kind of an allocation, which actually acts as a goalkeeper in your portfolio, right? So it acts as a good hedge against inflation, against US dollar or currency risk, and even against different event risks. So the ability to optimize your allocation across each of these asset classes is also the flexibility that the fund offers.
Got it. And then how do you decide what is optimal allocation? For example, 60 or 65 to equity. How do you decide on that?
Yeah. So as a fund house, Bajaj Finserv AMC, what we have done is we've actually used a similar model also in our Balanced Advantage fund, where the predominant decision is between equity and debt only, right? You don't have commodities in that fund. But there, what we do is we actually take a look at both the fundamental view of the market, where we take a look at what is the right, let's say, value, the fair value zone for Nifty, for example, and what is also a sentiment indicator, right? So 70% of the weightage is on the model for the fair value, and about 30% we actually keep for what we call the sentiment indicator, right? And these inputs we actually get from other markets, which act as early warning indicators on equity markets. So, for example, commodity markets or bond markets, currency markets, all of these give clues to you based on the behavior of the traders in these markets as to what is likely to happen in equity as well. So the allocation between equity and fixed income typically is determined by the output of this model, and the allocation to commodities, which is predominantly gold, that is typically driven by a more or less a fixed decision to keep it as a hedge, instrument in the portfolio. So typically around 10 to 12%, unless circumstances, are very, very different compared to where they are today. And we feel the need to have an over-indexed allocation to gold.
Got it. And for your equity part, your NFO presentation mentions that you will be using a strategy called GDP, that is growth and dividend payout. Can you explain this strategy in plain terms?
Yeah. So the very fundamentals of equity investing, right? Whenever you do an investment in equity, it is with an objective of getting returns from the company that you're investing in, right? Now, price is one measure, but it's a measure which can change and fluctuate a lot. So dividends are actually real returns that companies provide. Right? So when you're buying an equity share, you're actually buying into a series of dividend payouts that the company is likely to give over a period of time. What we have observed is companies that actually give both dividends as well as growth, right, are very attractive companies for several reasons. Firstly, companies that are giving dividends obviously are profitable. When they are growing, that also indicates that it's not that they're just giving out all of their surplus profit as dividend, but they also have opportunities to grow their business. Management tends to be very accountable because they have to come to the street every quarter, every year and disclose their dividends and hopefully grow that as well over a period of time. The dividend itself, starts compounding over a period of time. And it's also tax advantage when it comes through the fund house structure, the mutual fund structure, as opposed to when it is in the hands of the investor, where it is taxed at marginal rates above a certain amount. Plus, what is even more interesting is, the valuations that the dividend yield kind of companies are providing, companies that have growth as well as dividend yield, are very attractive at this point of time. Right. So current market, even though people are seeing it at elevated levels, is actually providing very good entry point for investors into a strategy around dividend paying companies, which are also growing.
So I'm sure it will require an in-depth, research in identifying a sweet spot between growth, dividend payout, as well as, reasonable or low valuations.
Absolutely. And I think that's a critical part, Milan, that you mentioned. So it is not that we only look at very high dividend yield companies only, right? We also look at companies that generate growth. So we've identified a portfolio of about 70, 80 companies that do both, right? And it's the sweet spot is exactly that, that it has to deliver both. And when that happens, right, you get a beautiful effect where the dividend yield itself forms a little bit of a cushion in the portfolio. Fixed income provides an additional, stability in terms of, today you can lock in close to around 7.5% kind of returns as well. Plus, you get the mark-to-market benefit under an equity taxation. You get dividend under the equity taxation, and any returns from gold as well is coming under equity taxation. So, you get the benefit of mutual fund structures for taxation, and you get a good cushion room, which acts as sort of a risk mitigant for many investors, and even that cushion actually keeps compounding over time, right? So that's the benefit that this scheme offers.
Got it. And particularly on the equity side, looking at the current market scenario, where do you see most promising opportunities?
Yeah, so when we look across different cap categories, Milan, clearly we've seen a bit of a run up in the mid cap as well as in the small cap space. Mid cap probably a little bit higher run up than maybe even in small cap. But actually we see the Nifty and the large cap space in more or less a fair value zone, right? Because while of course people say that the market has gone to all-time highs, but even earnings have actually grown, right? So compared to that, the valuations are pretty close to what we would see as fair value valuations at this point of time. So of course, the expectation has to be that now earnings will drive. It's not going to be a multiple re-rating, right? But there are clearly opportunities that we see in the large cap space very much. Plus, with any investments that come in from FIIs, which a lot of them are waiting for results on the near term, post elections, we see a significant amount of flow that is likely to also start coming into the economy, which will also provide a lot of tailwinds for the large cap and maybe some quality mid caps as well. Even within mid cap and small cap, while overall valuations have gone up, we do see opportunities, right? So there are a lot of companies that have very good order books, very good prospects, very good, opportunities for profit growth as well, and run by good management. So we certainly see opportunities over there. But for us, the large cap space looks particularly attractive at this point of time. In terms of sectors, we clearly see industrials. We see some very interesting opportunities in pharma and the contract research and manufacturing space. While financial services we may face a little bit of near-term headwinds, but we do see that the power sector, infrastructure and industrials, as well as pharma, will have quite a lot of good opportunities in the near term.
Interesting. And on the debt side, how do you approach investing in debt in this particular fund, and what kind of factors do you look at?
So at Bajaj Finserv AMC, Milan, we tend to be very, very risk averse in terms of taking credit risk in the fixed income side, right? So our approach is very much to see what are the opportunities in the yield curve and from a duration management perspective, right? So what we've done is we've built out a model which can reasonably accurately predict the 10-year GSEC rate with maybe about a 70-75% confidence level, right? Now with that, you can actually use level, slope, curvature to reverse fit your yield curve and see where the opportunities lie, right? And that becomes the basis for us to see what are the opportunities in the fixed income space that can help us derive returns for our investors, right? So in the multi-asset fund that you asked about, our approach will be to leverage that to see where the opportunities will be, given what's happening in the US, given the flows that are likely to expected with the JP Morgan bond index inclusion, as well as the Bloomberg inclusion as well, which could happen in a period after that. So based on that, based on the flows and based on where we see the opportunities, that's where we will be deploying our money in those maturity buckets.
Got it. And coming to the commodities part of the fund, the NFO presentation mentions that investing in gold or rather bullion helps to spread out the risk. So could you explain, how does this work, and also what do you think are the reasons for recent rise in gold and silver prices?
Sure. So by and large, if you take a look at it, Milan, what you will see is gold actually acts as a counter-cyclical hedge to equities, right? Current market conditions are a little bit of an exception, and I'll explain why that is the case. But by and large, if you look at history, gold becomes a hedge in the portfolio, right? It's like the goalkeeper, as I mentioned, in the portfolio, which protects against inflation risk, it protects against currency risks, as well as in the case of extreme events or wars or such scenarios, it acts also as an event risk hedge, right? Now coming to the current scenario, what is really driving the price of gold actually is more central bank buying, particularly China, and actually interestingly enough, this time in China it's also household buying of gold. Now that usually is an indicator of fear in that economy, right? Whenever the central bank as well as households are significantly buying gold, that indicates that there is very likely a crisis in that economy, and people are looking at alternatives to equity or other investment instruments, and typically going to a store of value, right? So gold acts as a really good store of value for that from that perspective. So I think till the current property issues, the crisis in the banking sector, till there is a clear visible end to that, I think that is quite possibly likely to continue. And that's where we see, the current price rise in gold is being driven largely by that. And once that comes off, then you'll see a little bit of reduction in demand, which obviously will have its own impact on price.
And finally, Ganesh, which type of investor should consider investing in Bajaj Finserv multi-asset allocation fund?
Yeah. So the ideal investor is someone who wants to participate in the market, but is not looking for a very volatile experience with which at times equity can provide, right? By investing in a multi-asset allocation fund like ours, investors actually gain the benefit of participating in multiple asset classes, be it equity, fixed income, or gold. They end up getting some of the benefits of diversification of their portfolio, but also of professional asset allocation. So, for example, if the environment changes and you need to switch between equity and fixed income or equity and gold, doing that within the mutual fund structure actually is significantly beneficial, rather than if the investor were to do 3 different funds and have to redeem from one and then invest in another. There's tax implications of those, right? In the mutual fund structure, that tax implication is not there. So getting professional asset allocation across asset classes is very meaningful for investors, and it gives significant advantage to do it within the multi-asset allocation fund structure. Now, given the kind of structures that we are going to be investing in, the strategies that we will be deploying, right? In the equity side, investors also get the benefit of dividend yield under the mutual fund taxation structure, which also then comes under equity taxation at the time of redemption. The fixed income yields are reasonably good at today's rates, and any mark-to-market gain also comes in under equity taxation, not debt taxation. And finally, any returns that gold also provides comes under equity taxation. So many of these advantages, are very much in favor of people who are looking to invest reasonably large sums of money, but are worried, let's say, about the market conditions at this point of time, and don't want a very volatile experience going forward. So for those investors, I would think that this is the right kind of product to invest in.
So an all-weather investing with an optimal taxation rate.
That's correct.
Ganesh, thank you so much for taking our time for this discussion.
My pleasure, Milan.
All the best for the NFO.
Thank you very much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.